What if I told you there's one institution that secretly affects the price of your groceries, the rate on your mortgage, and whether you have a job? You've probably heard of it, but do you really know what it does? Today, we're breaking down the Federal Reserve in the simplest way possible. Every time you stare at a bill and wonder why everything costs so much, or why borrowing money feels so expensive, you're feeling the Fed's effect. It might seem abstract, but trust us, this stuff is deeply personal. Let's make it make sense. Prices going up? That's called inflation. When it gets out of control, your money buys less and less every single day. Someone has to be in charge of fighting that, and that's exactly what the Federal Reserve does. Whether you're looking at your credit card rate, your car loan, or your savings account, all roads lead back to one place, the Fed. And every decision they make ripples through your wallet almost immediately. Let's follow the money. Think of the Federal Reserve as the economy's head coach. It doesn't play on the field itself, but every game plan comes from the coach's decisions. And just like in sports, a bad call can cost everyone, big time. So, welcome to The Fed Explained. By the end of this video, you'll understand exactly what the Federal Reserve is, how it works, and why every American, and honestly the whole world, needs to pay attention to it. To understand the Fed, we have to go back in time, all the way to the early 1900s. Back then, the United States had no central bank, no single authority managing money or banking, and the results were not great. In 1913, Congress passed the Federal Reserve Act, and President Woodrow Wilson signed it into law. That single document created the institution we now call the Federal Reserve. It changed American finance forever. Before the Fed existed, financial panics were basically a regular American tradition. A rumor would spread that a bank was going broke. People would rush to withdraw their savings all at once, and the whole system would spiral into chaos. These were called bank runs, and they were terrifying. Ordinary people would lose their life savings overnight. There was no protection, no safety net, no backup. The system was dangerously fragile. The Federal Reserve was built to be that stability. It would act as a backbone for the banking system, a lender of last resort that banks could turn to in a crisis instead of collapsing. It was a revolutionary idea. The Federal Reserve Act established a system of 12 regional Federal Reserve banks spread across the country. At the heart of it all is the Board of Governors in Washington, D.C., which oversees the whole operation. Today, the Fed is led by the Federal Reserve Chair, currently Jerome Powell. The chair is appointed by the president, confirmed by Congress, but operates with a high degree of independence. That independence is critical, and we'll come back to why. The Fed has what's called a dual mandate. That means it has two equally important jobs. Job 1, keep inflation stable. Job 2, support maximum employment. These two goals guide every single decision it makes. Here's the tricky part. Those two goals can sometimes pull in opposite directions. Fighting inflation means slowing the economy, which can reduce jobs. Supporting employment can overheat the economy and drive inflation. The Fed must constantly balance both. The Fed's main lever for controlling the economy is interest rates, specifically something called the federal funds rate. Think of it like the economy's thermostat. Too hot? Turn it up. Too cold? Turn it down. The decision on interest rates is made by a special committee, the FOMC, the Federal Open Market Committee. This group meets 8 times a year and decides whether rates go up, go down, or stay the same. Every meeting is a major event in finance. Before each meeting, the FOMC closely examines economic data, inflation reports, employment numbers, consumer spending, and more. They're trying to get a clear picture of where the economy is heading so they can make the right call. One of the things the Fed controls is the money supply, essentially how much money is floating around in the economy. More money circulating can boost growth, but too much causes prices to rise. It's a very delicate balance. The federal funds rate is the overnight rate that banks charge each other to borrow money. When the Fed adjusts this rate, it sets off a chain reaction through the entire financial system. It's the most powerful lever in the global economy.
When the economy is struggling, people aren't spending, businesses aren't hiring, the Fed steps in and lowers interest rates. Cheaper borrowing means more spending, more investment, and more jobs. It's like giving the economy a big caffeinated boost. And just like watering a plant helps it grow, lower rates give the economy the conditions it needs to flourish. Businesses expand, new workers get hired, and consumer confidence starts to return. It takes time, but it works. When rates are low, the economy tends to grow. Stock markets often rise, businesses invest more, and the general mood improves. History shows us again and again that rate cuts have helped pull the U.S. out of downturns. Lower rates make credit flow more freely between banks, businesses, and households. Loans become cheaper, credit becomes more accessible, and money moves through the economy like water through an open pipe. Growth follows. But sometimes the economy gets too hot. Prices skyrocket, demand far outstrips supply, and inflation runs wild. When that happens, the Fed does the opposite. It raises interest rates to cool everything back down. High inflation is the Fed's alarm signal. When prices are rising too fast, the Fed acts aggressively to bring them under control. It's not always comfortable, but it's absolutely necessary for long-term stability. When borrowing becomes more expensive, people and businesses think twice before spending. That big purchase you were considering? Maybe it can wait. That's exactly the point. Slowing demand brings prices back into line. For businesses, higher rates mean the cost of financing goes up, expansion plans get shelved, new hires get put on hold. It slows things down, which is intentional. The Fed is deliberately pumping the brakes on an overheating economy. The Fed is always watching both inflation and deflation. Inflation is too many dollars chasing too few goods. But falling prices, deflation, is also dangerous because it causes people to delay spending, which can crash the economy. The Fed aims for the sweet spot. One of the Fed's tools is open market operations, buying or selling government bonds in the open market. When the Fed buys bonds, it injects money into the economy. When it sells, it removes money. This fine-tunes the money supply with precision. Through bond transactions, the Fed can steer interest rates and control liquidity without anyone really noticing. It's quiet, technical, and incredibly powerful. Traders and investors watch every Fed bond purchase very closely. The Federal Reserve also acts as a bank for banks. It holds their reserves, lends them money in emergencies through something called the discount window, and provides the backbone that keeps the whole banking system from collapsing. In extreme crises, like in 2008 and 2020, the Fed can deploy an advanced tool called Quantitative Easing, or QE. It pumps massive amounts of money into the economy by buying up financial assets, trillions of dollars injected directly into the system. And just as the Fed can flood the system with money, it can also pull money back out, a process called quantitative tightening. Like squeezing a sponge, it absorbs excess liquidity from the economy to prevent overheating. Okay, so we know how the Fed works, but here's the big question. What does all of this actually mean for you, your family, and your day-to-day life? The answer is absolutely everything. Dreaming of buying a home? The Fed's decisions directly determine your mortgage rate. When rates are low, homes become more affordable. When the Fed raises rates, mortgage costs can jump hundreds of dollars a month, making homeownership much harder. Thinking of buying a car? Your auto loan rate is directly tied to the federal funds rate. A Fed rate hike of even 1% can add hundreds of dollars to the total cost of your vehicle over the life of your loan. Credit cards are even more immediately impacted. Most credit cards have variable rates that rise almost immediately when the Fed hikes rates. If you're carrying a balance, every Fed increase hits your monthly bill directly. There's a silver lining too. When the Fed raises rates, savings accounts and CDs pay more interest. For savers who've been earning almost nothing on their deposits, a rate hike actually works in their favor. It finally rewards people for being responsible with money. During the Fed's aggressive rate hikes from 2022 to 2024, high-yield savings accounts briefly offered over 5% returns, the best rates in over a decade. If you had money sitting in savings, the Fed's actions actually put more money in your pocket. The stock market is deeply sensitive to Fed decisions. Investors are constantly reading between the lines of Fed announcements, trying to predict the next move. Even a hint that rates might change can send markets swinging wildly. When the Fed hikes rates aggressively, like it did in 2022, stocks often fall hard. Expensive borrowing hurts corporate profits, reduces investment, and makes safer assets like bonds more attractive compared to risky stocks. But when the Fed starts cutting rates, markets often rally. Cheaper money flows back into stocks, business sentiment improves, and investors feel optimistic again. The Fed's pivot from hikes to cuts can supercharge a market recovery. The job market is one of the most powerful ways the Fed's decisions touch everyday Americans. Low rates encourage businesses to expand, open new locations, and hire more people. When money is cheap, companies bet bigger on growth. On the flip side, high interest rates cool hiring and sometimes cause layoffs. When borrowing costs rise, companies shelve expansion plans. You may have felt this in 2023 and 2024 as the job market cooled significantly after years of Fed rate hikes. Your purchasing power, how much your dollar actually buys, is directly connected to Fed policy. High inflation erodes your buying power silently. If your salary goes up 3%, but prices rise 6%, you're effectively earning less every single year. At the grocery store, gas station, or anywhere you spend money, you're feeling inflation in real time. The Fed's core mission is to keep that 2% inflation target so that prices rise slowly and predictably, not wildly and erratically. Here's the hardest truth. There's no perfect answer. Every Fed decision involves trade-offs. Fight inflation too hard and you risk a recession. Stay too loose and prices spiral. The Fed is constantly walking a tightrope with enormous consequences. Let's talk about some pivotal moments in Fed history. In 2008, the U.S. housing market collapsed. Banks had taken enormous risks on bad mortgage loans, and suddenly the entire financial system was on the edge of total collapse. Fed Chair Ben Bernanke responded with everything at his disposal. Rates were slashed to zero. The Fed launched massive bond buying programs. It literally backstopped the entire financial system, preventing a second Great Depression. Then came COVID-19 in 2020. The economy went into cardiac arrest almost overnight. Businesses shut down, unemployment skyrocketed, and the stock market crashed 34% in just 33 days. It was economic shock like nothing since 1929. The Fed moved at lightning speed, cutting rates to zero and launching trillions in emergency support. The recovery was remarkably fast, but all that stimulus money, combined with supply chain chaos, set the stage for what came next. Inflation surged to its highest level since the 1980s, over 9% in 2022. The Fed responded with the most aggressive rate hiking cycle in 40 years, raising rates 11 times in rapid succession. It was monetary policy as a fire extinguisher. Throughout all of this, one theme has remained constant. The Federal Reserve's independence is what makes it effective. Politicians want cheap money. The Fed has to sometimes say no and do the unpopular thing for the long-term good of everyone. In 2025, this independence is under pressure. President Trump publicly clashed with Fed Chair Jerome Powell, demanding faster rate cuts. Economists worldwide warned that political interference in the Fed could undermine U.S. financial credibility, with serious global consequences. So let's land the plane. Here are your key takeaways. 1. The Fed controls the most important interest rate in the world, the federal funds rate, and it affects nearly everything in your financial life. 2. The Fed has a dual mandate: fight inflation and support jobs. Every rate decision is trying to serve both goals at the same time. When they conflict, that's when things get really complicated and really interesting. 3. You can use the Fed's signals to make smarter financial decisions. When rates are high, pay down debt aggressively and lock in savings yields. When rates fall, it might be a great time to refinance a mortgage or take out a loan. The Fed isn't some distant institution that only matters to Wall Street. It's the invisible hand behind your mortgage, your job, your savings, your retirement. Understanding it puts you in control of your own financial story. And that's a wrap. If this video helped you finally understand the Federal Reserve, give it a like, drop a comment with your biggest question, and hit that subscribe button for more money concepts broken down simply. You've got this. See you next time.